talk about the difference between the term, whole, and universal life insurance policies that are discussed in the course. They comprise about 90 to 95% of policies that are out there. So they're most of what you're going to run into when you're looking to buy life insurance. Term life insurance is going to be insurance that you have for a specified amount of time, and you'll have protection during that time. In the event of death, there will be a payout. The benefit paid if the insured dies during that time is what was stated in the original policy. Otherwise, there's no benefit paid and there's no cash payout. It's just the policy expires. There are different types of term life insurance. So that's what makes this conversation so challenging when we're looking at term, whole, and universal. There are different types of term, different types of whole insurance, different types of universal. But basically, with term insurance, you can have coverage that stays the same and the premiums can change. So the premiums can increase or they can stay the same. You can have decreasing term life insurance, which means that the premiums stay the same and the amount of coverage decreases. So it really just depends on what you want. When you're looking at decreasing term, for example, if you want to have a mortgage paid off at the time of your death for your dependents so they don't have to worry about it, decreasing term might work because your premiums are going to stay the same, but you're going to need less insurance, life insurance, because your mortgage principal is going to be lower as time goes on because you're making payments. So there's straight term versus decreasing term. You have to renew the policy when it expires, and it could be converted to a whole life policy. So that's a possibility for a term insurance policy. Okay, so how do we read this table? These are the representative renewable term life annual premiums that would be paid by someone who doesn't smoke with a payout of $100,000. So if we have this 25-year-old male as an example, in the first year of their policy, they're paying $164. In the fifth year of their policy, so we can see the amount of the premiums are increasing as time goes on. In the 20th year of their policy, when they're 45, the annual premium is $228. Here we have like a 60-year-old female. In the first year of their policy, they're paying $471. Maybe years 2, 3, and 4, they're also paying the same amount. I'm not really sure. This is kind of truncated information. But in the fifth year of their policy, they're paying $685. And in the fifth year of their policy, they're going to be 65 years old. So they are still only going to receive $100,000 if they were to pass away in their 65th year, same as the 25-year-old. They're going to receive, as a 30-year-old, they're going to receive $100,000, and they're going to be paying $167 per year. This is showing that the premiums are increasing and the amount of the payment is not changing. So that would coverage remain the same while the premiums can increase as the insured ages. So this would be a straight term life insurance policy, term insurance that has a straight term to it. Okay, so term insurance. So term insurance is a good way for young families to purchase life insurance, and it has a disadvantage to it, though, is that it can get really costly as you get older, and there's no cash value to it. So just like your auto insurance, like you're paying, you're never having an accident, you don't want to have an accident, and you can't get any of those premiums back. So that's why a lot of people look to whole life insurance. So whole life insurance provides insurance for the individual's entire life. It's a sort of permanent insurance system. And there's a cash value associated with it if the person does not pass away during their lifetime. When we look at the chart here, we see the annual premium costs for someone of a specific age. So this male is having to pay $25 per year, or sorry, this 25-year-old male is paying $1,057 per year, and the payout is $100,000. So if they make those payments of 25 or $157 per year, and let's see, if they make them for 20 years, so they're kind of like, getting that particular rate, they're going to be making about $21,140. I'm not sure why this is negative, sorry. 1057 times 20. So they're making $21,140 in premium payments in the 25 years in which they have the policy, or the 20 years in which they have the policy. This cash value column represents the amount that the insurance company will definitely pay out. They might, in addition, pay out dividends, which is an extra $15,000. So let's see how much of the premiums were eroding here. Oops, sorry, I did that wrong. So 21,140 minus, okay, if they don't pass away at the age of 45 and they want that cash payout because it's a whole policy, then they're definitely going to get $14,116 back. Okay, they might get the dividends back, and the dividends are $5,439. And they may even get, so let me move the calculator here, what is called the paid up year 20 value, which is they may in addition get an additional $17,964, which would definitely help them exceed their total premiums that were paid. But these dividends and the paid up amounts are not guaranteed. Okay, so that's how I would interpret this. You can look at it for any age range here, and essentially what you're seeing is that this person has this life insurance policy that will pay them out $100,000 in the event of their death over the 20 years that they're making payments. And in addition, if they decide that they don't want the policy at the end of the 20 years, then they can cash it out and receive income. So it sort of is like a little bit of a savings plan. So what would they potentially get, right? They could eventually get this paid up amount of $17,964, plus they could get the dividends of $54.39, plus they could get the cash value of $14,116. So they could get up to $37,519 in the event that they do not pass away, that they don't need the life insurance, and they cash out their policy. Okay, so whole life policies, like term, there are different kinds. Level premiums paid until death or policy cancellation, limited payment level premiums paid for a specific number of years, and then they change, and single premium lifetime coverage purchased with one single premium. Whole life is a savings vehicle, as we see, if you do not die during the time in which your policy is intact and you're making payments. You can have a policy where the premiums remain constant, so that's helpful, and the cash value accumulates tax-free. The disadvantages is that it doesn't provide a lot of death protection for young people. It's a relatively low return on your savings. There are tax penalties for early withdrawal, and the premiums tend to be high. So, I mean, this person is paying quite a bit, and they're really only guaranteed this $14,116, which does not even meet the amount of their premiums that they pay in if they if they take the non-forfeiture right, which is their right to cash it out and obtain the cash value when canceled prior to death. So that's definitely a risk Universal life insurance is the third type we're going to talk about here. So it's a permanent cash value insurance that combines both a term insurance with a tax sheltered savings account. It provides death protection plus a savings feature, and the savings grow at current interest rates versus some guaranteed minimum rate. So if we look at this table, how do we read it? So here we have representative universal life insurance annual premiums that are paid. So these are all the different types of premiums that would be paid for someone with a particular age. So I would like a universal life policy. I'm a 35-year-old male. My annual premium is going to be $1,172. If I make payments for 20 years until the age of 55, I'm going to be making $23,440 in payments. Those are the total aggregated value of my premium payments. So for 20 years, I'm making payments of, let's see, 1172. Okay, so I made $23,000 in payments in that 20 years. At current rates, the cash surrender value that I can receive back would be $18,000 at 2% in 20 years. But maybe the interest rate is a different rate. So we're using annual current rates, and maybe that interest rate is 2.95. I would get back 23,560, which is the cash surrender value of the policy in 20 years. We're kind of getting closer to the amount of premiums that we've paid for 20 years with this different rate, but we just don't know what interest rates are going to be, and that is a risk of the universal life versus having a guaranteed rate. So something to kind of think about. Term life insurance is only going to pay out if there's a death and there's no cash value associated with the plan. But here, if this 35-year-old male makes premium payments for 20 years and they don't pass away, they can receive the value of those premiums back. Otherwise, the policy could be utilized if they do pass away during that time period. So that is all I wanted to discuss here. I just kind of wanted to help you think about how to read through these tables, and please reach out with any questions.